Well, stocks are mixed this morning as the latest initial jobless claims report comes in at the lowest level in 16 months. Now, this is just the latest piece of data showing that the economy remains strong and aggressive rate cut bets may have been overstated. With that in mind, we also heard from Atlanta Federal Reserve President Raphael Bostic warning against cutting rates too soon, saying the worst thing for the economy would be to cut rates and then have to raise again. We'll hear more from Bostic at noon on his economic outlook. Well, joining us now is Young Ma, BMO Wealth Management U.S. Chief Investment Officer. Thank you for joining us this morning. So, Young, as you look at some of this latest data that we're digesting, especially on the heels of what we saw with a still spending consumer, what does this economic outlook then mean for how markets should be interpreting it?
Yeah, it's great to be here. Thanks, Rochelle. Yeah, we have had some strong economic data generally, but a few mixed data points as well. We see consumer spending is strong. We saw today's print for jobless claims really come in at a very surprising level, especially when we're expecting a soft patch here with some of the economic data that we saw, such as the New York Manufacturing Index. So I think it's fair to say we'll see some mixed data over the next couple of months, but let's keep that in perspective that if we're going to have a soft landing, the first word in soft landing is soft. So we're not expecting all of the data to come in strong, but we do expect the overall trajectory to be relatively stable here. So we think investors can take comfort that we're in the later innings of the soft landing and that this year, as we look forward into 2024, we expect a reacceleration of growth in the back half of the year. So we think that's what investors should be focused on.
So the later innings of a soft landing, what does that ultimately mean for how quickly the Fed cuts rates? It feels like we've seen sort of a pullback of expectations here, as we've heard more from Fed officials this week saying not so fast.
Yeah, we think the market's really got quite a bit ahead of itself in terms of thinking of when and how aggressively the Fed would cut rates. If we think of the Fed's job description, the Fed has a dual mandate. One is maximum employment and one is price stability. And if the maximum employment box is well checked off, really, the Fed is going to focus on price stability. And as you heard the Atlanta Fed president talk about, the Fed definitely does not want to find itself in the position of having to raise rates if inflation were to pop back up toward the end of the year, or even next year. So it really wants to play the long game here. And I think the market was really looking for sort of a quick fix, but the Fed is really looking on a longer trajectory.
And so then as we look at the volatility that we're still seeing at the moment, in your note, you say patience is going to be warranted in Q1. So for investors who are sort of wondering, does that mean I keep my cash on the sidelines or are there opportunities there? How should they be looking at this opportunity?
Yeah, we do think patience is warranted here in the first quarter. For investors that have cash on the sidelines, it probably makes sense just to scale in to the market with that cash over the next 6 to 9 months. We think that's a good approach here. But we think in the latter innings of the soft landing, we will get mixed economic data, and the Fed will be relatively slow to cut rates. So we don't think the market right now where it is, the equity market, is going to have a repeat of the last couple of months of November and December and just be in strong rally mode. We think it'll be much more of a sideways market, some consolidation of the gains we had at the end of the year. And we have to give some time for the soft landing to play out and give some time for the Fed to feel more comfortable cutting rates. And then if we look to the second half of the year, we can see the path toward a reacceleration of growth. So right here, we're expecting more of a sideways market in the first quarter, some consolidation of those huge gains at the end of 2023, which we shouldn't forget how strong those were and investors benefited from. But with cash on the sidelines, it makes sense to gradually scale into the market here.
We've certainly seen the Fed lead the way in terms of major central banks on that expectation for a rate cut. There's another central bank a lot of investors, foreign investors, have been watching, which is the Japanese market, given where the Bank of Japan's likely to move. It sounds like you're watching that market very closely right now as well. I mean, what are the opportunities you see there that you think maybe investors should be increasing exposure in that direction?
Yeah, that's a great question. We actually do like Japanese equities here. We do think the structural reforms that have taken place in Japan in terms of shareholder friendliness, improvements in corporate governance, really focusing on a return of capital to shareholders, M&A activity, share buyback activity. All of these things point to longer term trends that are very much a shift in corporate culture in Japan and friendliness to shareholders. we think that's going to have a multi-year runway here. So investors, as they're deploying capital in 2024, we do think the Japanese market is one that they should pay attention to and has been very much underinvested in by international investors over the past decade or so. So we do think that's an area that's going to have a favorable trajectory going forward, not just on a 1 quarter, 2 quarter basis, anything can happen, but really on a multi-year basis, those structural changes tend to have a lasting effect. So we're very positive on Japanese equities here.
And as we look at some of the risks, obviously geopolitical risks, a big year for elections as well, when you factor that into the potential for a soft landing versus a recession, and you look at what we've seen with the yield curve starting to flatten as well, how optimistic are you about the recession picture?
Cautiously optimistic that the recession is not going to happen, and that we're going to achieve the soft landing. The risks you talked about are important. We don't want to dismiss those, because what happens when we have more of those risks that are present in the economy, it creates a sense of fragility and an environment where if there is some type of negative shock or something unexpected that happens in the economy, all of a sudden you can get a derailment of that economic growth or a derailment of some of the soft landing dynamics that still look to be in place here. So the risks are important to focus on, not because we think the current risks are strong enough to derail the soft landing, but it has injected an element of fragility and uncertainty that we have to pay attention to if other factors start coming into play here.
Young-Yu Ma, BMO Wealth Management U.S. Chief Investment Officer. Always good to have you on the show. Appreciate the time today.
Thank you, Kiko.